If you study economic history closely, a clear pattern emerges, one that has repeated itself for hundreds of years. There is a specific phase in every economic cycle when leaving money sitting still isn't merely a poor choice, it becomes a decision capable of wiping out decades of disciplined effort. We are moving rapidly toward one of those phases in 2026. This is not a forecast or a guess. It is the natural outcome of the economic cycles that shape how our system functions. Today, I'm going to explain why leaving your money untouched in traditional savings accounts or even locked into certificates of deposit could turn out to be one of the most damaging financial moves you make over the next 2 years. And more importantly, I'll show you exactly how to respond. History is one of the best teachers we have, and right now it's sending a loud warning that most people are ignoring. Let's begin with a fundamental reality. Money is an illusion. I don't mean that in a philosophical sense. I mean it in a very real, measurable way. The dollar in your pocket today is not the same dollar you held in 1980. It isn't the same as the dollar you had in 2000. And it certainly won't be the same dollar you'll hold in 2030. If you had stored $100,000 under a mattress in 1980, that money would still exist today. But its buying power would now be equivalent to roughly $30,000. The money didn't vanish. What disappeared was its real value, slowly and consistently worn away over time. This brings us to the first cycle you must understand: monetary debasement. Whenever governments face major stress, wars, pandemics, financial crises, or deep recessions, they respond in the same way. They create more money. This happened during the Great Depression. It happened during World War II. It happened during the 2008 financial crisis. And it happened on an unprecedented scale during the pandemic of 2020. Between 2020 and 2022, the United States created more money than it had during its entire prior history combined. Pause for a moment and consider that. Over 240 years of monetary history were eclipsed in just 2 years. The consequences of that decision are still unfolding, and by 2026, they will be impossible to overlook. To understand why 2026 matters so much, you need to understand how the economic system truly operates. Picture the economy as an enormous clock. Each gear represents a key component: productivity, credit, inflation, employment. When these gears move together in balance, the result is steady, sustainable growth. But when one gear breaks or is forced to spin too fast, the entire mechanism falls out of alignment. Over the past 4 years, several of these gears have been artificially accelerated through aggressive monetary and fiscal policies. Credit was pushed into overdrive with near zero interest rates. Consumer spending was boosted through direct stimulus payments. Liquidity was flooded into the system through massive asset purchasing programs by central banks. Now we've reached the inevitable phase of correction, and throughout history, every adjustment follows the same rule. Real assets hold their value. Paper money does not. By real assets, I mean things that retain their usefulness no matter how much currency is created. Ownership in productive businesses, real estate, commodities, precious metals. By paper money, I'm referring to bank balances, low-yield fixed income instruments, and cash itself. The gap between these two groups is about to widen dramatically in the years ahead. To see why, let's rethink inflation in a way you may not have considered before. Inflation isn't simply about prices going up. Inflation is a structured transfer of wealth away from those who hold money and toward those who own assets. Here's how that transfer takes place. When new money is created, it doesn't instantly show up in your checking account. It enters the economy through banks and financial markets first. Those closest to that flow, banks, large corporations, institutional investors, are able to use this money to acquire assets before prices rise. Those further away from the source, salaried workers and retirees living on fixed incomes, experience the higher prices without ever having had a chance to shield themselves. This process is known as the Cantillon effect, named after economist Richard Cantillon, who described it in the 18th century. But you don't need the name to understand the outcome. When you leave money sitting idle during inflationary periods, you are effectively handing over your purchasing power to others. Now let's look at real numbers from 2024 through 2026. Even if official inflation figures suggest 3 to 4%, the inflation you actually experience in daily life, at the grocery store, at the gas pump, and in housing costs is much higher. Housing prices have climbed roughly 25% over the last 3 years. Food costs are up around 20%. Energy prices have surged by about 30%. If you left $100,000 untouched during this time, you effectively lost between $20,000 and $25,000 in real purchasing power. And this pressure is far from over. Once you understand incentives, you understand how people behave. The incentives lining up for 2026 are creating a perfect storm, one that will make leaving money idle extraordinarily costly. The first incentive is the scale of American national debt. It has already exceeded $33 trillion and continues to grow at an accelerating pace. Just servicing this debt, paying the interest alone, now consumes more than $1 trillion every year from the federal budget. This means that even if no new government programs are introduced, the state still needs an ever-increasing amount of money simply to cover interest on what it already owes. So where does that money come from? The same place it always does. More dollars are created. The second incentive comes from demographics. The aging U.S. population is generating historic fiscal pressure. Every single day, over 10,000 Americans turn 65 and qualify for Medicare and Social Security. This trend will continue for roughly the next 15 years. The result is mandatory government spending that expands automatically, regardless of political preferences or policy debates. The third incentive is geopolitical reality. Strategic competition with China and Russia is driving higher military and infrastructure spending. No matter which political party controls Washington, these expenses are viewed as non-negotiable for national security. The fourth incentive is more subtle but equally dangerous. The banking system is under quiet strain. Hundreds of regional banks are holding large unrealized losses on bond portfolios purchased when interest rates were near historic lows. When these losses are eventually realized, and they will be, government intervention will once again be unavoidable. All of these forces point in the same direction: more money creation. And the more money that is created, the less purchasing power is held by money that simply sits still. To understand what this means in real life, let me share a story from the 1970s, a decade that closely mirrors many of today's conditions. It's the story of two families living next door to each other in suburban Chicago, the Martinez family and the Thompson family. In 1970, both families had savings of $50,000, a very large sum at the time. The Martinez family chose what seemed like the safest option. They placed their money in a savings account earning 5% annually. It felt responsible and conservative. After all, it offered steady growth with no apparent risk. The Thompson family made a different choice. Guided by an uncle who understood economic cycles, they divided their savings among stocks, real estate, and precious metals. It appeared far more uncertain. Now fast forward to 1980. The Martinez family's savings account had grown to $81,000, a 62% increase over 10 years. On the surface, that sounds impressive. But here's the catch. Over that same decade, cumulative inflation reached 112%. In real terms, the $81,000 in 1980 could buy less than half of what the original $50,000 purchased in 1970. The Martinez family worked hard, lived modestly, saved consistently, and ended up poorer than when they started. The Thompson family experienced a very different outcome. Their assets grew to $195,000 over the same period. They not only protected their purchasing power, they multiplied their real wealth. This is not a fictional example. It is the pattern that repeats whenever economies move through extended inflationary periods. Now consider a more extreme historical case, one involving a complete loss of confidence in a currency. In the 1920s, Germany's Weimar Republic faced exactly this situation. The government printed enormous amounts of money to pay war reparations and fund domestic spending. At first, people who kept German marks in savings accounts believed they were acting wisely. But as money creation accelerated, the currency lost value so quickly that it eventually took wheelbarrows of cash just to buy basic necessities like bread. Who was protected during this collapse? Those who owned real assets, stocks, real estate, gold, and even tangible goods like food and fuel. Who was wiped out? Those who held their wealth in cash and bank savings. I am not suggesting the United States will experience hyperinflation like Weimar Germany, but the underlying mechanics are identical. When excessive money is created, real assets tend to retain value, while paper money steadily loses it. Now let's make this concrete and directly relevant to you. If you currently have $100,000 sitting in checking or savings accounts, you are effectively losing $3,000 to $4,000 every year in purchasing power if inflation runs at just 3 to 4%. If inflation rises to 6 to 8%, which is entirely plausible given the forces we've discussed, that loss grows to $6,000 to $8,000 per year. Over 5 years, that becomes $30,000 to $40,000 in lost purchasing power. Now scale that to your own circumstances. If you hold $200,000, those losses double. If you have $500,000, they increase fivefold. For someone approaching retirement, this erosion is devastating. Imagine planning to retire in 2030 with $1 million. If that money remains idle and inflation averages 6% per year, your $1 million will effectively be worth about $750,000 in today's terms. This isn't a minor inconvenience you can brush aside. It's the difference between a secure, comfortable retirement and one defined by financial stress. For younger families, the long-term impact is even more severe because time works against idle money. If you're 35 years old with $50,000 sitting untouched and you keep that money safe for the next 30 years until retirement, even a modest 4% annual inflation rate will reduce its purchasing power to less than $15,000 in today's dollars. In contrast, if that same $50,000 is invested in a diversified mix of assets that historically exceed inflation by 4 to 5% per year, it could grow into $200,000 to $270,000 in real purchasing power. The gap between these two paths is not minor. It's the difference between struggling financially in retirement and living with comfort and security. Based on everything we've covered so far, here's what you should do. This is not personalized financial advice, but rather educational principles you can apply with the help of a qualified professional. Never concentrate everything in one place, but also never leave everything in a system that is fundamentally failing. In this context, that failing system is paper money. A simple structure designed to protect against inflation might look like this: 40 to 50% in high-quality company stocks, especially businesses with strong pricing power; 20 to 30% in real estate, such as REITs or directly owned property; 10 to 15% in commodities and precious metals; 5 to 10% in inflation-linked bonds; and 10 to 15% in cash for flexibility and emergencies. Notice that only a small portion, about 10 to 15%, remains in cash. That's enough to handle emergencies and seize opportunities, but not so much that inflation steadily destroys its value. It's also important to understand that not all assets perform equally well during inflationary periods. The strongest protection tends to come from businesses that can raise prices without losing customers. These include companies providing essential consumer goods, utilities with contracts tied to inflation, technology firms with closed ecosystems, and real estate located in high-demand areas. On the other hand, it's wise to avoid heavily indebted companies, businesses operating in highly commoditized industries, and fixed-income securities that lack inflation protection. Economic cycles shift over time. What works well today may fail tomorrow. That's why it's important to keep at least 15 to 20% of your portfolio in liquid assets that allow you to adjust quickly as conditions change. This can include diversified funds, liquid ETFs, or even temporary cash positions during transition periods. You can't know exactly when inflation will speed up or slow down. What you can do is prepare yourself for multiple possible outcomes. Make changes gradually over a period of 6 to 12 months, rather than all at once. If you'll need the money within the next 2 to 3 years, keep a conservative reserve even if it loses ground to inflation. In the short term, market volatility can be more damaging than inflation itself. If your time horizon is 5 years or longer, you can accept more price swings in exchange for better long-term protection against inflation. Markets change, economic cycles change, and your personal circumstances change as well. Set aside time on a regular basis to review how your decisions are performing and whether they still align with your goals. When people try to implement these strategies, they often fall into the same traps. Many become so focused on making the perfect decision that they end up making no decision at all. There is no perfect solution. There are only choices that are better or worse than leaving money idle. Taking imperfect action is far better than doing nothing. Some people learn that gold can hedge inflation and put everything into gold. Others realize that stocks have historically beaten inflation and invest exclusively in equities. But remember, the objective isn't to chase the highest possible returns. The goal is to protect and grow purchasing power while managing risk responsibly. Others say they'll wait for the next market crash before investing, or they'll stay in cash until inflation cools down. While they wait, inflation quietly eats away at their wealth every single day. Any realistic strategy must also account for taxes and transaction costs. In many cases, what looks best on paper becomes less effective once those factors are included. Creating a strategy is only the beginning. Keeping your allocations aligned over time is just as important. If stocks perform very well, they might grow to represent more than 60% of your portfolio when your target was 45%. That's when rebalancing becomes necessary. Since the future is impossible to predict with certainty, the goal is to prepare for a range of outcomes. Based on today's fundamentals, the most likely scenario is ongoing, moderate inflation in the range of 4 to 6% per year. Under those conditions, a well-diversified, balanced approach offers solid protection without excessive volatility. If geopolitical tensions or fiscal pressures intensify, inflation could rise to 7 to 10% annually. In that environment, increasing exposure to commodities and real assets becomes especially important. Although it's less probable given current fiscal realities, a deep recession could briefly push the economy into deflation. In that environment, having some liquidity and the flexibility to seize opportunities becomes critical. This was one of the defining fears of the 1970s, and it is something that could reappear. Another possible outcome is stagflation, a toxic mix of high inflation and weak economic growth. In that case, assets that perform well regardless of growth, such as utilities, REITs, and precious metals, become especially valuable. The objective isn't to perfectly predict which scenario will occur. It's to build a portfolio that performs reasonably well across all of them, rather than wagering everything on a single outcome. Now that the core principles are clear, the next question is how to apply them in real life. Start by taking a full inventory of your finances as they stand today. How much money is sitting in checking and savings accounts? How much is locked in CDS or low-yield bonds? How much is invested in markets? How much is tied up in real estate? For each category, consider your time horizon, your risk tolerance, and your financial goals. Next, define your target allocation. Decide what percentage belongs in each asset class. Determine the minimum emergency reserve you need. Identify which specific investment vehicles make sense for your situation. And most importantly, don't try to change everything overnight. Make adjustments gradually. For example, move about 25% per month out of poorly allocated positions. This approach reduces timing risk and gives you room to adapt as new information emerges. Continuously evaluate how your strategy is performing. Are your allocations still aligned with your targets? Have your personal circumstances shifted? Do economic conditions suggest adjustments are necessary? Every 6 months, rebalance your portfolio to maintain your intended structure. Trim a portion of what has grown too much. Add to positions that have fallen below their target weight. This process naturally encourages buying low and selling high. Now let me be absolutely clear about one thing. Every financial decision carries a cost. Investing in assets comes with trade-offs. Volatility, the possibility of losses, complexity, taxes, and fees are all part of the equation. But leaving money idle also carries costs. Guaranteed inflation, missed opportunities, and exposure to monetary debasement. The real question isn't how to avoid costs altogether. It's which costs you are willing to accept. Inflation is quiet but unavoidable. Month after month, year after year, it steadily erodes purchasing power. Investment volatility, by contrast, is loud but temporary. Some years are painful, others are rewarding, but over the long term, the trend favors preserving and growing real value. For most people, especially those who won't need their money for the next 3 to 5 years, the hidden cost of inflation is far greater than the visible cost of volatility. What matters is making this choice deliberately, not by default, fear, or inaction. History shows that periods of heavy money creation are always followed by phases of wealth redistribution. This isn't about politics. It's about mathematics. When more money chases the same amount of goods and services, prices rise. When prices increase faster than the returns on conservative savings, wealth shifts from cautious savers to asset owners. This transfer doesn't happen through force or confiscation. It happens quietly, through the persistent mechanism of inflation. If you pay attention to the years ahead, you'll see this process unfolding in real time. Those who recognize it and prepare accordingly will not only protect their wealth, they'll grow it. Those who ignore it or cling to outdated ideas of safety will eventually realize that what they thought was safe was actually the greatest risk. True financial security doesn't come from avoiding all risk. It comes from understanding risk and managing it intelligently. The greatest danger in 2026 won't be market swings. It will be the comfort of doing nothing while your money's value is steadily drained away. This isn't speculation. It's the natural outcome of the economic cycles that shape our world. The decision is yours, but choosing inaction is still a decision. And in 2026, it will be an expensive one. Once again, history will reward those willing to learn from it. The only question left is this: will you be among those who learn or among those who pay the price? If you want more videos breaking down stories like this, make sure to like and subscribe. Thanks for watching.